Hi, I'm Jamin Yi, and on behalf of my colleagues at Roehl Yi, welcome to another edition of our Money Manager interview series. A foundational part of our investment management strategy is due diligence. Our goal is to select great organizations and people to manage our clients' capital. I hope you enjoy getting to know some of the managers we utilize and gain some perspective and insights on their respective strategies. Today we're joined by Daniel Davidowitz, Portfolio Manager at Polin Capital. Polin Capital is a manager that was added more recently to Roehl Yi's approved list. Dan is going to discuss Polin's large cap strategy, the current environment for growth investing, and their market outlook. This interview was recorded on September 2nd, 2021. The views and opinions expressed here are as of the date recorded and should not be construed as an offer to buy or sell any securities. Such views and opinions may differ from those of Roehl Yi investment advisors and are subject to change without notice. Welcome, Dan. Thank you for joining me today. I'm excited to have you.
Thank you.
Excited to learn more about you and your firm. And congrats on all the success of your firm.
Thank you very much. Thank you.
So my wife and daughter are not very interested in investing. How would I explain your firm's strategy to them?
Well, if they're not very interested in investing, I wouldn't bore them with how we invest. But if you want to know what Polin Capital does, we're a purpose-driven firm that has products that are really created for one reason, and that is to help protect and then grow our clients' capital over time. So we do that through a very consistent investment methodology that we've applied now for over 3 decades. And we can certainly talk in more detail about that. But the biggest attributes are that we run a highly concentrated, very high quality growth portfolio. And we should probably define some of those terms as we talk, but we only invest in the most financially superior and competitively advantaged businesses and nothing less than that. And we find that that helps us generate excellent returns over time, but also creates a portfolio that we believe is less risky because we don't own businesses that have a lot of debt, that don't have competitive advantages, that are highly regulated. We take out a lot of the things up front that make investing more risky, in our opinion.
So if we just shift to your firm's outlook, what do you see with the economy and the markets for the rest of the year and early next year?
I wish I could give you a really good answer on that. It's interesting because at Polen Capital, we don't really make predictions about the economy, the markets, or anything like that. And it's not because we don't have thoughts. We certainly have thoughts about them, as everybody does. Is that we don't think we're very good at predicting them. And we think that it actually isn't that important for investment returns to do that. And that may seem contradictory because you certainly should have an outlook on the market or on the economy. And if something bad's going to happen, you wouldn't want to be invested. But that's really not the way that we think. And the reason for that is the companies that we invest in tend to be all-weather companies, meaning they continue to grow through whatever the economy throws at it, right? These are companies that have secular growth. They don't get really swung around by the US or global economy. They're often in businesses that they've created, industries that they've created and dominate and have long growth prospects ahead of them. So what happens in the short term with the economy typically doesn't meaningfully affect them. So that we can then opt out of the decision. We can opt out of having to make a strong prediction about that. Now, if I look back over the last 10, 12 years, the stock market's been straight up in the United States with only a few pauses along the way. We would not have predicted that, 12 years ago. What's happened with coronavirus, quarantines, the impact on the global economy, the reopening, we wouldn't have predicted any of that. In 32 years, we didn't predict bubbles, bursts, wars, pandemics, business cycles, interest rate cycles. We didn't predict any of them. What we just did is invest in 20 to 25 great companies that should be able to thrive regardless. So I hate to punt on the question, Jamin, but
No, and I can appreciate that. So if you look at Polen Capital and the large cap growth strategy, how would you say that you would do? What environment would you do well, and what environment would you not do well?
Well, at first I'll take it in the long-term time horizon because the way we think, and so because our companies grow on a portfolio weighted average basis, our companies grow in excess of 15% per annum earnings per share growth. So if you were to aggregate up all of our holdings as if they were one big company, the earnings per share growth is about 15-16% per annum. At least it historically has been that. We think it's actually going to be a little bit faster going forward, but let's just use that mid-teens type earnings growth rate. Over the long term, our returns have roughly followed that earnings growth, and we believe that that makes sense. Over time, returns should roughly follow earnings growth, and that's been our experience. So if you think about that, compounding at 15%, we've actually been closer to 16% for 32 years. That's going to do well regardless, right? That beats pretty much any index. It beats most of our competitors. It's very, very hard to compound at that higher rate for 30 plus years. If we can continue to create the portfolio like we have today that allows for that kind of earnings growth, I think we'll still be able to do well over any long-term time horizon. When you break it down into shorter term time horizons, which I think is the nature of the question, is in different types of environments where things are in and out of investment fashion, how do we do? We typically keep up with the market at least most of the time. We tend to do a lot better than the market in down markets. So when the equity markets are declining, it doesn't mean that we don't decline, that our portfolio doesn't go down, but it typically goes down less, or it has in the past anyway, gone down less. The reason I think for that is we own much, much better companies than the average company, financially very, very strong. There's no risks of bankruptcies or severe cyclicality or anything like that. Our businesses will continue to grow, usually in times of economic contraction. And so I think that is the reason why we've typically done very, very well relative to the market in down markets, but we tend to do well in up markets as well. So it really depends. The times that we trail the market significantly are when quality is not being rewarded. So there are times where you'll see low quality rallies, or kind of cyclical rallies where people want to invest in say industrials or energy companies or levered financial institutions and those kind of things. And we don't own any of those type of companies. So if that's what's leading the market, we're gonna trail. But that's not most of the time. Most of the time, quality wins, growth wins, earnings growth, that is, wins. And so we're usually pretty advantaged.
And how would you define quality?
We actually put metrics on quality. So everybody says they invest in quality. I've never heard anybody say they invest in quality companies, at least in stocks anyway. I know some bond investors that do that and do it very well. But for us, quality has to do with a few things. So we have 5 investment hurdles that every company has to meet for us to be able to invest in those. We call them our guardrails. And so there are 5 financial metrics, and they're kind of a quality indicator. Each one of them is a quality indicator for us. So we want companies to have a cash-rich balance sheet with very little, if any, debt. So that's criteria number 1. So we don't entertain businesses that have a lot of debt. Number 2, you have to have excess free cash flow every single year, not just here and there, not just infrequently, not just most of the time, every year, excess free cash flow. You have to have returns on capital that are sustainably above 20%. That's a very, very high hurdle and an indicator usually of competitive advantage, because if you have high returns, somebody's going to try to compete with you and drive down those returns over time. So if you can sustain 20%, that's a pretty good indicator. So that's number 3. Number 4, you have to have increasing profit margins, at least flat to increasing profit margins. And number 5, you have to have real organic revenue growth, not just the benefit of an economic or industry cycle, and certainly not benefit from acquisitions. Something real, unique, special that's better than average. So when you think about those 5 criteria, each one of them is pretty high hurdle. Every company we invest in has to meet all 5. And so that makes the universe of companies that we can invest in very small. Our team is a global team. So the product that I help manage is a US strategy, but our team supports 3 strategies that invest across the globe. And when we look at the companies that meet our guardrails, about 90% of listed companies do not meet those thresholds, or said the other way, only about 10% of listed companies that are large enough for us to invest in will meet our guardrails. And then our research is going to narrow down that universe even finer. So we have extreme extreme thresholds for quality, I think, that are above what most people would look for.
No, that's great. Thanks for explaining that. So if you talk about, I think you said investment fashion, and we look at the current market, and we'll talk about FANG and the big tech companies, Facebook, Amazon, Apple, Netflix, Google. You include Microsoft in there. And if you look at their current valuations, what are your concerns that they're getting too big, regulatory risks, and then just future growth?
Yeah, it's hard to take them all as a group because the dynamics are different for each company. And we own most of the ones that you mentioned. The one that's conspicuously absent from our portfolio is Apple. We have owned Apple in the past. We've been absent from Apple for the last 5 years because we feel that they've pretty fully penetrated the high end of the smartphone market globally. And so growth will slow and has been slow for the last few years. And we think will likely stay relatively slow and not as attractive to us. And then the valuation also not very attractive to us as well. When you look at, say, Amazon versus Google and Amazon versus Google, Facebook and Microsoft, they're all a little bit different as well. So certainly Google and Facebook are more alike than any of the others because they're advertising driven business models, but search advertising is different than display advertising, which is more of what Facebook is, social media advertising. Amazon does have a very large advertising business as well, but it's not as big a percentage of their business, certainly. So when we look at each one individually, we're thinking about how big they are today, how big can they get? The addressable market for a lot of these companies is quite large. And a lot of, as I mentioned, Google invented search advertising. Facebook kind of invented social media advertising, at least how it's done today. These are businesses that kind of created and now dominate by these companies and then are expanding their addressable markets as well. So when we think about how big they can get without much real competition, it gets pretty exciting. The valuations are really not that high on these companies. I think there's a lot of skepticism still for some of the reasons you mentioned, Jamin. Regulation is one that people are concerned about. The law of large numbers, how big can they get? From our point of view, we still think there's plenty of growth potential left in all those companies. We think the valuations are quite attractive. They're among our largest holdings today. And then on the regulatory risk, we actually don't see very much today that we think would change the business model substantially of any of these companies. So we can get a little bit more into the details of regulation if you'd like on each of those businesses, but what we see from regulators right now are a lot of random shots across the bow without a whole lot of substance behind them.
So just to kind of pivot and maybe get a little into the weeds, you look at Alphabet and is it the Wamco? I'm going to butcher the name.
Yeah.
Waymo. Thank you. What do you think the future of Waymo is and just driverless cars as you look at that?
I do believe at some point we will have fully autonomous vehicles in the United States and hopefully globally, but I don't know if it'll be in our lifetime or not. It's hard to really know. There's a lot of structural issues you have to get over before it becomes a real substantial thing. So when we're evaluating Alphabet, Google's parent company, and we're thinking about all of the things inside of Alphabet, we're not valuing all of them, or we're not considering any of them as far as upside to our expectations. So we look at Alphabet's core business, search, YouTube, for sure, Google Play, for sure. The things that are real generating assets, revenue generating assets today, we include those in our future assumptions about what the business is going to look like. Waymo, we don't apply any value to, or any of the other bets, as they call them. We don't apply value to them. In fact, you can argue we apply negative value to them because we see the impact through the P&L. It's a negative impact, right? It's a cost with no revenue today. And we just assume that's going to still be the case going forward. So we kind of assume it's a cost of business for Alphabet to retain the best engineers in the world. You have to let them work on some really awesome projects. And we don't know if they'll prove out in the long run. I do believe fully autonomous vehicles will be here at some point, but hard to know what the the true revenue impact could be on Google, if anything.
So you're saying it's still primarily advertising? Is that fair to say? And that's
Yeah.
their growth driver. I don't think you need to be.
Advertising and some of the monetization around YouTube subscriptions and Google Play, and there are other monetization, but yeah, it's mostly search and display ads.
So I believe PayPal's in your portfolio.
It is.
So what are your thoughts in the future of just digital payments?
I mean, digital payments, there's a bright future in digital payments, and we own Visa and MasterCard as well. So we own Visa, MasterCard, PayPal. You know, the digitization of payments has been going on for 50, 60 years in the United States, not a new phenomenon, but it's becoming a little bit more mobile oriented, right? So tap and pay type things or transactions using mobile wallets are becoming increasingly a bigger and bigger share of of how payments are transacted. And so we see that as a very, very bright future. We think the vast majority of payments will be fully digital in the future. Today, we're still not even close to that. Even in the United States, we're only about 60% penetrated, and that includes cards, just physical cards. So debit, credit cards, and online payments are still only about 60% penetrated today. So that still leaves another 40%. And even though we're 60 years into this in the United States, there's still plenty to go. And then when you go outside the US, it's way, way earlier on that. And so, you know, we think roughly about 40% of global payments have been digitized today. So it's still a long runway for growth. One of the things that I found fascinating a couple of years ago, and it's probably still true today, Visa had mentioned a couple of years ago that the amount of cash in the system that I guess could be displaced at time by digital payments was actually larger a couple of years ago than it was when Visa came public in 2008. So even though digital had become a larger share of the whole, cash was actually still growing at a slow rate. So that just shows you, you know, when you think about companies like Visa, MasterCard, and PayPal, they wake up every day with almost double-digit revenue growth just because of the secular transition toward digital payments, right? If you think about how payments happen, about 5% every year, people spend about 5% more every year than they spent the year before that. So you flow those through these digital payments companies every year, they're processing 5% more payments than they were processing the year before. Then the secular shift towards digital and away from cash and check adds another almost 5% to that. So by literally just waking up every day, Visa, MasterCard, and PayPal grow about 10% before pricing, before any market share gains from each other, which typically doesn't really happen all that much. There's a bright future. And then there's things that could add on top, you know, things like PayPal's trying to create a super app now that will do more than just act as a payment mechanism. It could do other things like purchasing, right, cryptocurrencies or stocks or whatever, kind of like Square's Cash App. So there's a lot of things that can be monetized in digital payments that are still there for the future.
So independent of crypto or DeFi, what are your thoughts of the blockchain and how, you know, the PayPals or the Visas or even like, you know, the stock markets and just seeing instantaneous settlement? Thoughts on what the blockchain is going to go?
Blockchain is very exciting, right? So separate blockchain from Bitcoin or any other cryptocurrency. So just focusing on the underlying blockchain technology, we think one of the things you mentioned, instantaneous settlement in equity markets, would be a very smart and very good use of blockchain technology instead of waiting 3 days for settlement. Smart contracting, logistics, like monitoring global logistics, cross-border trade, all of these things, cross-border currency conversion, all of these things can be done very well with blockchain technology. So we think that the applications of blockchain technology are vast and will likely be very, very important to the global economy going forward. As far as how that affects the payment companies, it's a little bit harder to know. Right now, Visa, MasterCard, PayPal, they're all accepting certain cryptocurrencies. And so they're basically just acting with cryptocurrencies the same way they do with fiat currencies, which is essentially just making sure transactions happen and currencies are converted. So they don't really take any risk by doing that. They're just allowing for acceptance on their network of whatever currency you want to use. And so that opens the addressable market even more than it was before. The real question in the very long term is, can blockchain technology be used to settle transactions that used to be done, say, on debit cards. So getting rid of the need for an intermediary like Visa and MasterCard, can you replicate that through blockchain technology? Today, it's no. The answer is no. You can have Visa and MasterCard that can literally process or reverse process tens of thousands of transactions per second. Right now, Bitcoin on blockchain can only do about 7 transactions per second. So you're not even in the same world as far as real life applicability. But in the very long term, it's possible, and so it's something that we're monitoring, but it's probably, again, not likely in my investing lifetime.
Gotcha. So thank you. That was interesting. So if you talk about your firm and looking at the investment world from a global perspective, thoughts on China today, and certainly there's been a lot of headline news with China recently. So any perspective on China?
Yeah, and our team talks about it a lot. So for me, I'm thinking about it more through the lens of U.S. companies operating in China, right? Because that's the portfolio I run is U.S. companies. But our team, obviously, we invest in China in our other strategies. So it's something that we talk about a lot. There are risks, and we've always known there are risks in investing in China that are different than investing anywhere else. The VIE structure of the equities that we invest in mean you don't technically own the company that you're investing in. You own a contract that supposedly gives you kind of a pass through to the economics of that business, but legally we know we don't own that. So that alone is a risk. What's happened in China, starting with the Ant IPO that had to be kind of scuttled, and Didi being chastised, and then the essential nationalization of for-profit education, shows that if the government has a problem with a business model, they are not going to be shy about shutting it down or causing a massive problem if they think it's really crucial to the wellness of their citizenry or kind of common prosperity that they're really going for in China. So there are places where you can invest, but it may not make a lot of sense to if you might run afoul of some of the issues that the Chinese government or the party really has some concern over. And so education, healthcare, housing are definitely kind of in the crosshairs, so to speak. So you have to be very careful when you're going to invest in China. I think you have to be very aligned with the things that the party thinks are important. That common prosperity, number one. I think it's really important to be on the right side of investing in companies that are doing well for the social good of the Chinese citizenry, and understanding that you may have limits on profitability there as well. The government can mandate what you should invest in as a company or what you shouldn't invest in. And I think you just have to take that on and understand that. So the burden to invest in China is higher than it is in other places. Although I would say there are other countries that are far worse that we may never invest in. But in China, you just have to be careful. You just have to understand that there are things about investing in China that make it a little bit more difficult to understand, how safe those investments are. So we take a very pragmatic approach. We will only invest in Chinese companies where we think we have real competitive advantage and we think the businesses can thrive and that the government is very unlikely to have a problem with it.
So our firm's based in the Pacific Northwest. And certainly some of our clients think about impact investing and sustainability and ESG. So I was just curious how your firm and your process, your strategy specifically, incorporates any of the ESG process into your portfolio.
We've actually always incorporated it before we actually knew what ESG was. If you think about the way, because we've been doing this for a long time, everything about investing to us has to do with the sustainability of a business, right? How sustainable is the competitive advantage and the growth prospects? And so that in and of itself is not sustainability the way you're talking about it. But in order to have a real sustainable business, you better be doing the right things for the environment, for people, having proper corporate governance, proper, almost everything be on the up and up, right? And so whenever we're researching companies, we're looking at all the risks to a company, and some of those naturally fall into those ESG buckets and some of them don't. right? We look at competitive risk, we look at regulatory risk. Those don't fall in under those buckets, but we look at all of the risks to a business, and we always have. Now under the parlance of ESG, we've added a little bit more so that our clients can have a clearer perspective on this. And so we require all of our companies to be good corporate citizens, and that nothing will get in the way of their ability to compound. If we think that any of those risks that typically fall into ESG risks could affect the long-term compounding of one of our businesses, then we're not going to own it. So we don't really care what the ratings are from a company like Sustainalytics or MSCI. We don't really care about that. What we care about is the true risks to a business, and we're going to make sure that we're not going to be in the way of those. Probably the clearest thing that we can point to on ESG, though, is how we vote our proxies, right? So a lot of these issues come up on proxies, and we typically vote along, good sustainability governance lines. And so if things come up about gender equality and gender pay, or diversity, or executive compensation, or different share class voting rights, we typically vote on the side of the sustainable or ESG, good ESG practices is typically the way that we vote. Not all the time, depends on the circumstance or context, but we typically do want our companies to be good corporate citizens. But we also don't exclude companies if they're not doing everything right. So probably the best example here is Google, right? If you look at Google's share class structure, the public traded shares have much lower voting rights. So the insiders have 10 votes per share. One of the share classes that we invest in has 1 vote per share, and one of them has 0 votes per share. And we don't think that's poor corporate governance, and we vote against it all the time. Of course, because we have diminished voting rights, nothing really happens with that. But we don't think it's enough to not invest in Alphabet. We think that it's one of the things we don't like, and we let the company know that we don't like it. But we think in the totality of Alphabet and the investment thesis, it's not enough to not own it. So it's incorporated in what we do. It's an important part of what we do. It's now more clearly articulated than it probably was before.
I hope you enjoyed today's interview and gained some perspective and insights on Dan and Polen Capital's investment strategy. Be sure to tune in to the second part of our interview, where we discuss managing people in a results work environment, culture, Polen's investment committee, and getting to know Dan outside of the office.